Hello, everyone. Welcome back to Signal or Noise. This is episode 22. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, we got a lot to run through today. We're going to discuss 5 millionaire myths, a couple of smart tax moves before April 15th, the retirement withdrawal dilemma. That's an interesting one that a client posed to us. Breaking up the Realtor monopoly, some big news there. Should TikTok be banned in the U.S.? Big debate going on. Congress obviously just passed a bill. And we're going to end, as we always do, with Signal or Noise. Two interesting topics there. One dealing with sentiment, the other one, the unemployment rate. So let's dig in. Start with 5 millionaire myths. I want to start with a tweet that you put out and talking about the losers and liars who have their own agendas and want you to believe that you can't become a millionaire. There's a lot of myths surrounding this. Tell me your thoughts. Is it still attainable to be a millionaire today? And what should people be thinking about in terms of how to get there?
You know, it's so frustrating because when you look on social media, Robert Wright was one person who just put out a message a long time ago saying most billionaires inherited their most money, most billionaires inherited their money. It's like a blatant lie, and it's very easy to validate that that's not true. The overwhelming majority of people that become millionaires get there by just having a job and saving in their 401k. This is very well documented. It takes about 3 seconds to validate. Other people become millionaires because they buy a home and they pay down their mortgage. And while they're paying down their mortgage, they might also have an IRA. They might also have a 401k. You put it all together. And as they do that over their lives, they become millionaires. Those are the ways people become millionaires. And a lot of people become multimillionaires in different ways. But the point is, most people don't inherit it. And I think what's so harmful about the messaging is what it sends, the message sends to a young person is you can't do it. If you didn't inherit the money, you can't do it. If somebody didn't hand you a bunch of money when you were young, you can't do it. If somebody didn't pay for you to go to an Ivy League school, you can't do it. And it's just not true. The most common path is a very straightforward, very attainable path for anyone born in the United States. So I find it very frustrating. I message about this a lot on social media, particularly on Twitter, where I keep giving examples of how to do this because it's not very hard. Is basic things you have to do. Kind of ignore all the people that tell you it can't be done. They usually have their own agendas.
Absolutely. Yeah. And for anyone who hasn't seen our 10 Steps to a Million episode, I'll put a link in the show notes to that. We can walk you through there. And correct, you have to dig into the agenda. Why is that person saying that thing that's clearly false? And there could be any number of reasons. Usually it's politically motivated. There's a lot of comments around class warfare, and there's certain people that it's become an industry to try to
Yeah.
keep people down and say
Yeah.
you can't do things and therefore you need me or need
Mhm.
me to tell you why things are unfair and provide excuses for you, and the exact opposite, encouraging and showing the path, is what they should be doing. So let's dig into some of these myths. 5 millionaire myths. There was an article on creative planning. We'll have a link to that as well, written by Danny Johnson, one of the wealth managers at Creative Planning. And she talks about 5 different myths here. Number 1, this is the one you were talking about. Millionaires inherit their wealth. So that perception that if you don't come from a rich family and you're not inheriting it, you can't do it. Simply not true. 79%, Peter, didn't receive any inheritance at all. I think that the fact that it was 0 would
Right.
shock a lot of people.
Yeah, I think it's really surprising to people. And the reality is that most people are starting from zero, and life expectancies are long enough that by the time you're 50 years old in the United States, most people still have at least a parent with them. So even at that age, they haven't inherited anything. Most people that achieve millionaire status, their parents gave them nothing, or their parents are still alive and in utilizing their own money. So this you have to inherit. It's not just not true, it's upside down from the reality. Looking at this statistic of 79% should be very encouraging to literally anyone that's young in the United States.
Awesome. So number 2, this is a great one. It's easy to spot a millionaire. I love this tweet that you put out here. One thing you learn over the years is there's plenty of people that look like they have nothing, but are actually super wealthy, and plenty of people that look super wealthy, but actually have nothing. And I have a few stats here on car brands. Most popular 3, they aren't Ferrari and Porsche, or Toyota, Honda, and Ford. 61% of millionaires drive one of these 3. Spending on clothes is actually lower for millionaires than the average American, and so is spending at restaurants. What's been your experience, and how did you come up with this tweet here? Definitely true, of course. We know many examples of this, like if you looked at Warren Buffett and people like him, but you wouldn't guess that they're a millionaire or a billionaire. But what's been your experience with this?
Yeah, my experience has been the Millionaire Next Door book was spot on, with the idea that most millionaires are pretty humble people. They're driving pretty humble cars, living in nice homes, but not homes that are grandiose. That's the typical millionaire next door. I would say it's even the typical multimillionaire next door. Now, there are a lot of people that are spending almost everything that they have or are living beyond their means. There's no question, right? But if you are looking for what's the typical, the average millionaire or multimillionaire like, they're not showing it off a lot. That's how they became millionaires and multimillionaires. It allowed them to put more money away every month, not spending it on having a bigger house or a nicer car. They're taking that money and they're putting it in an IRA, or they're putting it in a 401k or a rental property or a business or something that's bringing money back to them. So, number one key to becoming a millionaire is you take some portion of your earnings and you put it in things that bring money back to you. And cars don't bring money back to you, they take money away from you. Houses don't bring money back to you, they take money away from you. So, it makes logical sense, right? That typical millionaire or multimillionaire next door isn't overspending on those things. Instead, they're saving. Now, that doesn't mean there's plenty of multimillionaires that are driving nice cars and living in big houses. Of course, that's true. But the average, the typical millionaire, multimillionaire, they're putting more of those dollars away. That's how they got there in the first place.
No question. I think what's difficult is for people. It's hard to decipher between the two. So you see that person with the nice clothes or
Mm,
fancy car, and your assumption, of course, is that they're rich. And maybe
right.
a second assumption after that is, well, I have to do those things to be rich as well.
Right.
When it's, of course, the exact opposite. If you spend 30,000 on a car instead of 60,000, well, man, that 30,000 that you're saving and investing, you compound that over time, and that alone is going to get you to a million or more. All right. Number three, in terms of myths, you need a high salary to become a millionaire. And of course, I think it's would be easier to become a millionaire for anyone to have a higher salary. But this idea that you have to have a super high salary to get there, simply not true. 69% of millionaires actually average less than 100,000 in household income per year, and 33% never even reached a six-figure income throughout their career, which is kind of incredible. If we look at the top five careers here, Peter: engineer, accounting, teacher, management, attorney, typical jobs for a lot of people. I think teacher would stand out a lot, not necessarily always associated with very high pay. And they simply got there, obviously, through saving, investing, and time.
Yeah, I mean, teachers are a great example of how what savings does, because a lot of teachers have forced retirement savings. So even when you're starting out in your 20s, money's going in your retirement. You work your whole career and you've become a millionaire. So it's definitely you can save your way there almost no matter what your salary is. But let's be very honest here. Obviously, a higher salary makes a very big difference, and it's sometimes lost in the discussions of, oh, hey, skip Starbucks and save. I'm not a big believer in, a lot of denial of day-to-day things that might bring you some joy. The key is if you save a certain amount when you're young, there's a clear path to become a millionaire. Obviously, that's easier to do if you're making 100,000 a year instead of $40,000 a year. So both sides of the ledgers matters, how much you're earning, how much you're spending, but at the end of the day, the number that matters the most is what are you saving? Are you able to put money away into investments that bring money to you? It's easier to do if you have a higher income. It's easier to do if you have lower expenses. But one way or another, if you can put that money away, there's a path there for you, even if you've got a modest income.
Very simple. Yep. Living within your means, number one. If you don't, it doesn't matter what your salary is. If you
Right.
have lifestyle creep and you spend everything, and even if you have a high salary, you're not going to save anything. You're not going to build wealth. Okay. Number four, millionaires have degrees from prestigious universities. I think this would surprise a lot of people. The assumption is, oh, you have to go to an Ivy League school. That's all the rage today. If you don't, your life's over. You're never going to do well. You and I obviously both went to state schools, so
Right.
proving that you don't have to go there for sure. And actually, what I would say is that if you go to a state school and you save money by doing so, and has a similar educational value to a private school, actually could bring you one step closer to that millionaire status because you don't have this huge loans to pay off. And so that alone could be a big deal. So only 8% of millionaires surveyed went to these prestigious private schools versus 62% from public state schools. And the importance of education, Peter, you always talk about this, but 52% earned a master's or doctoral degree versus 13% for the general population. Can't overstate how important education is. Just it doesn't matter as much where you went, it matters the degree and what you learned and what you can apply from that.
Right. All of these things matter to a certain degree. And another thing that frustrates me online is when people say, oh, it doesn't matter if you go to college, which is total BS. It definitely matters if you go in terms of probabilities. Someone who doesn't go to high school can become a millionaire. Someone who only has a high school degree can become a millionaire. I know, and no exaggeration, hundreds of our clients who did not graduate from high school and became millionaires. And so those things are possible. But we know with certainty that if a group of people with a college degree has a higher probability of becoming a millionaire than a group of people with just a high school degree. We also know a group of people with a master's degree has a higher probability of becoming millionaires than people that went just to college. It's also true, despite this graph, that if you go to prestigious school, your odds of becoming a millionaire are higher than if you go to a school like I did. A state school, it's not as prestigious as say an Ivy League school. But there are other factors like what debt are you carrying with you, and what degree do you have? Right? I'd rather have a degree that can bring economics to me, that's in demand, IT, engineering, accounting, business, medicine, things like that from a state school than Russian history from an Ivy League school. If you love Russian history, great, God bless you, but it's not the high probability of bringing you the income you need to be financially successful if that's a priority for you. So there's a million different paths here. The key to me is definitely get a college degree and definitely get a degree that has economic value. If you can somehow get that from a prestigious university for the same price, well, great, or something similar, great. Otherwise, I'd focus on the degree over the school.
Yep, absolutely. It's certainly not to suggest that going to an Ivy League school doesn't have its benefits and won't help you. It's just that's not the end of the road. You still have to
Right.
do the work. You still have to prove yourself. And if you don't go there, well, many of the same opportunities will open up over time if you prove yourself. So
Yeah, I mean, the Ivy League
let's go to
school is obviously an advantage. When we say 8% of millionaires came from an Ivy League school, 8% of schools are not Ivy League schools. I mean, a disproportionate amount of people that go to Ivy League schools become millionaires relative to public schools, but there's still enormous odds that you can have a lot of financial success without doing it.
yeah, the interesting thing when I was doing this research here, the percentage of people that don't have any degree was actually higher than the percentage from Ivy
Yeah.
League schools. So I think it was like 11 or 12%. So interesting fact there as well. Okay, number 5 in terms of myths here. All millionaires are savvy, do-it-yourself investors. So there seems to be this perception that because you've made $1 million, that you got there through trading, investing, and making these kind of things only that would be known to certain investors, and that's simply not true. And it's also true that a lot of millionaires know their field of study very well, but their knowledge of investing and estate planning and tax planning and everything else is more limited, and so they outsource that to a financial advisor. Here's an interesting stat: 68% of millionaires actually work with financial advisor, and most began doing so before they achieve that millionaire status. How important is it to consider working with a financial advisor if this isn't something that you love to do? This isn't something that you're very knowledgeable about to help you get to that point.
Well, what's interesting is if you go over $10 million, the odds that that person is working with a financial advisor is over 90%, and over 25 million, it's over 95%. It's a pretty interesting deal here because you would think, well, God, they've got all this money, they're very sophisticated. What do they need the advisor for? But what you find is, number one, they appreciate more what a little bit of a difference can do for them, right? That's one. Two, they're, as you said, they're more used to delegating, saying, "Hey, I'm the best at this. I'm going to focus at this," or "I'm not the best at. I'm going to hope that this person does a little bit better than me." And they're also more focused on specialization, like, hey, somebody who is better at investing or legal or tax in these specific areas. If I could really get the right people in these places, it can make a difference for me. So they're more likely to lean into the financial advice. People who are starting out, obviously they're trying to save every dollar. They don't want to pay, right, for advice along the way too. And so it's interesting that as the accounts get larger and people have less of a need for an advisor in terms of becoming independent. It's more about wealth maximization. How do I pay less taxes? How to earn a little better in my investments? But they're not really trying to become independent. They're already there. They're more likely to use the advisor than somebody that really could probably benefit more from that advice.
Yeah, absolutely. So at Creative Planning, we're a little bit different than a lot of advisory firms in that we don't have that minimum of 1 million or 2 million. We work with a lot of people, all different income ranges, all different stages of their life. I think that's an important thing to get to know the person before that point in time, help guide them to get to that point. So, big emerging wealth division at Creative Planning. They do a great job. So, reach out to us. We got a link in the show notes to set up a call or meeting. We got in all 50 states, over 300 billion in assets under management and advisement, and we're here to help you get to that millionaire status, and we'll tell you the right way to approach it, and definitely won't scare you into saying it can't be achieved. So, number two here, Peter, unfortunately, income tax day is approaching here. I know you like to do taxes, so this is you're not necessarily concerned about this, but many Americans not so happy. A lot of work and effort has to go into the tax code. We're not going to dig into that today, but I will do it, I think, in the next episode where you and I can give our opinion on how to potentially simplify the tax code. I have a lot of thoughts there, but should people be thinking about as we get to close to this deadline? Well, I put together a list of three things here. Number one, the Roth IRA, traditional IRA, or SEP IRA, you can still fund it for the prior year. This is one of the interesting, weird things in the tax code. You could still fund it for 2023. So if you qualify for that, you should definitely think about funding it for last year. And if you have the money, obviously, this year as well, you don't have to wait until next year to fund it for this year. Number two would be the HSA. And you and I have talked about this has become more and more valuable, obviously, with increasing healthcare expenditures and more people having high deductible plans that have a lot of out-of-pocket expenses. And now you can put $7,750 per family for 2023. It's going to jump to $8,300 for 2024. So you could still fund it for last year. And give me your thoughts on the HSA and why it's so valuable for people.
Well, what I love about an HSA is it's like a Roth IRA, it just grows tax free for forever. So a lot of people put money in there, they get that tax break, and they love that it's growing tax free, and then they go use it for health needs because that's what the name is. But you don't have to do that. If you don't have health needs, don't feel compelled to take it out. Or if you can cover your health costs with outside funds, by all means do so, because the HSA will just keep growing your whole life completely tax free. It's just, I think, a glitch in the tax code. So
I don't know how they allowed that. Yeah.
yeah, let it accumulate as long as you can.
Yeah, what Peter's saying there is essentially if you have healthcare expenditures from this year, you don't have to take a distribution, even though you funded that HSA. You could wait 10 years, just keep those receipts, and then 10 years from now, take the distribution for the expenses that you incurred this year. So you can let that compound. You can invest it in different mutual funds and things, similar to an IRA, but even better in many cases because of that reason. You could just let it keep compounding over time. It's not taxable, and you get the added benefit if you get the deduction up front. So it's like a Roth combination of a Roth and a
Yeah.
traditional. You get the deduction up front, it grows tax free, and then withdrawals are tax free. So just an unbelievable thing. Again, I don't know how long they're going to allow that, but as long as they do, take advantage of it. And number three here, I think less people are thinking about itemized deductions because the standard deduction was increased a lot during the last big change in the tax code a few years ago. So more and more people are not taking the itemized deduction at the federal level. But what I like to tell people is don't assume that will exclude you at the state level. And because many states, in New York, where I live, being a great example, they did that limitation on the state and local income taxes and people's property. New Yorkers went crazy. The rest of the country loved it. Like stick it
Right.
to
I
New
think
York. But
California was with you, but other than that,
California, yes,
yeah,
right. Everyone else is like, good for you.
yeah.
We'll stick it to New York. But little known fact, and people in New York should know, is that there's no limit on the state level for your property taxes, so you can get the deduction there. There's just differences in terms of mortgage interest deductions in terms of states. So just keep your records, your charitable contributions, obviously, as well. Different rules for states. Some states follow the federal itemized deductions, but many states don't. So keep your records for that and check it out when you're filing your taxes. Might end up saving you a few thousand more than you think. Okay, enough with taxes. Again, we'll dig in on the next one about. I'll give you my thoughts. I have a lot of thoughts on how to simplify the tax code, so that'll be a fun one. Number 3 here: the retirement withdrawal dilemma. This was a question we got from a client, and it might seem simple at first, but when I started digging into it, not very simple at all. Here's kind of the background. Let's say you're 62 years old, you just retired, you have a Roth IRA, you got a traditional 401k, and you got a taxable brokerage account, but you don't have any source of income outside of this, and you need the money to live on. What do you do? Do you take Social Security right now and use that to live off of? Or do you delay taking Social Security until you're 67, which is the full retirement age today, or 70, and withdraw first from your IRA, 401k, or brokerage account in the interim? And here's the second part of the question. If you think you can make more than 8% per year in those other accounts, is it better to take Social Security early? And that question is centering around the idea that each year you delay Social Security, what you're getting is essentially 8% higher. So if you're 63, you get 8% more than what you would have received at 62. Now, might seem simple, right? Like there's a right answer, a wrong answer. And I started thinking this through, and the answer, as is often the case with these types of mostly tax related or age related questions, is it depends. So here's all the considerations. Tell me, Peter, if I'm leaving anything out. Number one, your health, right? Like when it comes to Social Security, I've talked about in the past. Yeah, the optimal thing, forgetting about the rest of the question, the optimal thing for people is to wait, because most people will live past the break even point, which is around 79 or 80. But if you have poor health and you don't think necessarily have a high chance of getting there, then obviously you're more your odds are better of taking it early. Then if you're a male or female, we know women live on average 3 years longer. So female more likely they should delay it, right? Because they're going to get that return. What about your spouse? So that wasn't part of the question. Are they still working? Do they have income? Are they retired? Are they already collecting Social Security? Then what I always like to ask first is, do you have money just sitting around in a checking account or savings account, especially checking account? If you have a few years worth of income that's just sitting there for a rainy day, you should probably think about using that first. In your taxable account, do you have long-term capital gains? I'll talk about a little bit why that's important. And then what's the consideration in terms of maximizing money to heirs? Because that might change the way you think about it. But first, I want to bust that myth of the 8% per year in terms of getting that. That's not a return. That is an increase in terms of what you're getting per year. But you don't know the return on Social Security until you die. It can't be calculated. And since no one knows when they're going to die, no one can calculate that return in advance. Peter, is there any way to break this down in any type of simple formula to tell this person what should I do or what should I do? Or is this something where an advisor or someone who's very knowledgeable, a planner, has to look at literally everything in minute detail and make a lot of assumptions and then go with the highest probability?
I think you've got everything nailed, and the other question becomes risk tolerance. Like how
Mm,
much are you willing to risk kicking it out into the future? Because obviously we don't know the future. We know if you take Social Security now, we know what you're going to get. To your point, you don't know the rate of return until you die. So that's the only factor I would add. There's so much that goes into this decision. I don't like that this program is set up in a way that this decision is so complex. So I'm not a fan of that for whatever that's worth. But I think it's definitely makes sense to pause, meet with your financial advisor or your accountant, really factor all the things that you've listed out here, and your willingness to take a risk that if you defer it, you may not get it at all, or you might get a very small amount.
Right. And as we talked about the last time in dealing with Social Security, psychology is so important. And for most people, the idea of potentially not receiving that or not receiving what they paid in, that is so painful to them
Right.
that they end up that's why most people take early, even if the optimal thing is
That's right.
obviously to delay it. And I think in terms of what you should take out, let's say you're able to defer it a few years, right? Because of some of the considerations we talk about. You have good health, and you have the ability to delay it because you have this money in these other accounts. Is there an account that you should take from first in terms of your brokerage, Roth IRA, traditional IRA? What I would say is it depends on the situation of those accounts. If you have a big capital gain in that taxable brokerage account, some people, and you don't have any other income, some people might not know this, but the first, basically, if you're married, your your first 94,000 in income can be tax free in terms of capital gains rate. So that's a huge advantage there. So if your main concern is minimizing taxes there, you can essentially, very very rare to get a tax free gain, right? In terms of capital gain, you can live off that and defer it. So my preference would be, if that's the case, take from there first. If you're able to pay 0% tax, right, then you can up your basis even. I mean, that's just an awesome thing in the tax code. And then go to something like the traditional. And the last thing I would probably take from is the Roth, especially if you're thinking about, you want to leave some of this
Yeah.
money to heirs. The Roth tends to be a good vehicle. It used to be that they could keep it essentially forever, but now I think there's a 10-year rule where
Right.
you have to divest it. But all of these considerations and more, and it doesn't have to be either or, I would say too. There might be a combination, and this is, you have to run the numbers here, a combination of a little bit coming from the taxable account, a little bit coming from the 401k. That makes sense for that person, right? Optimally tax wise. But anything with taxes, as we always say, also requires predicting what the tax rates will be in the future. So as long as this capital gains rate is zero, I would probably start there, assuming you have that built in. And if you have that money just sitting, like I said, in a checking account, start there first. So definitely delay as long as you can. But from there, you got to know the nitty gritty details, I think, to make an informed decision. And until you die, you won't know what was the best decision. You just have to make the decision, I think, that you're comfortable. And like you said, your risk tolerance, you feel good about, regardless of saying, oh, I could have made a few thousand more if I chose that. You don't want to have that type of regret. Nobody could predict that, in advance, because nobody knows a lot of these details going in. Okay. So number 4 here, breaking up the realtor monopoly. That might be a little bit of hyperbole, but there was a big settlement here with the National Association of Realtors, Peter. They paid $418 million. And what they're essentially, the ruling was, is that the way it works today, which some people might be familiar with, other people might not, but let's say the commission rate is 6%. The seller of the property was typically paying that whole thing, and half of it would go to the buyer's agent. And the way it worked was, on the multiple listing services that where the properties are listing, they required having the buyer's commission built into that listing. So the buyer's agent can click on there and see, oh, how much am I going to get for that? And the problem with that, of course, is that the buyer's agent might not show a property if the commission was lower. Many different problems from that. Also, since the buyer wasn't paying the commission, they didn't have incentive to lower that, right? So overall rates were higher, and just a non-competitive system overall, I would say, and kind of crazy to me that commissions are still this high when we've seen what's happened in something like the investment industry in terms of commissions going to zero. Before I give you, my thoughts on what this might change, what's your overall view of the industry? Is this a good thing for the industry. It might not be a good thing for that realtor, but it's a good thing for the end buyer and seller of a house.
Well, yeah, I think anything that makes things more transparent and that lowers the cost for the end consumer is obviously a good thing. I will say, I think a lot of people feel like this 6% goes in one person's pocket. And as you point out, it's split between the buyer and the seller agent, who then split that one way or another with the place that they work with, and then somebody's paying their team that they work with. So there's like a mythology that, like, this house, somebody puts 30,000 or even 15,000 in their pocket. That's not what happens. And
Yep.
so there's a lot more costs that go into this. I think it's actually a reasonable compensation for 99% of realtors. Although the structure of how it's paid, I agree that making it a little simpler and more transparent is going to result in the costs coming down.
Yeah, I just think that a lot with the technology today, if we look at what you can find on Zillow and Redfin, all these other websites in terms of today versus 20 years ago, how that doesn't disrupt this system is kind of mind-boggling because as a buyer, you can get so much information ahead of time on the internet about that home, about the listing, about the sales prices, all of that. Were probably 30 years ago, the realtor was doing all of that for you and really guiding you. And today you have this information at your fingertips. Does that make sense in terms
Well,
of
but I mean, to me,
shouldn't
like,
that disrupt things?
if that's the case, why are courts, why is anybody involved in this? Why, or is there anything about this other than letting the technology take over and do what it's going to do? I think despite all the things that you mentioned, people still call a real estate agent when they want to sell a house. Most people do. And I think that the courts could have stayed out of this, and over time, maybe the technology front would have taken over and solved all these problems on their own. I do find that this industry has been much less susceptible to technology than others. And I think one of the ones that surprises people the most, I think people really put this in the same category as many travel agents that would, many travel agents just went out of business, overnight because of technology. Obviously, the higher end ones not having the same issues, but a lot of people expected the same thing in the real estate market. It just hasn't happened yet.
Yeah, I think moving more towards a model, especially for the buyers, of what they're paying for what they're actually getting, as opposed
Yeah.
to a percentage. If all that realtor is doing is saying, "Here's a house," oh, the person already knows their house, and then they're getting $15,000. That
Mm,
doesn't seem
yeah.
reasonable. So maybe they get paid a lump sum by
Yeah.
the hour, something like where they're actually paying for the work. I don't know on the seller side that I guess you could argue, well, they might have to do a lot more work and advertising and things like that. But the buyer side seems to me more likely. If you're looking for a home, you could find it on the internet. You should be able to then call that seller or call the realtor who's representing the seller and say, "Here's my offer." And why should you need necessarily a buyer's agent to
Yeah.
do that if you know the property, you've done the research, and you don't want it?
Well, I would say that this is not my area, but this feels like something where there are going to be a lot of unintended consequences. It's just going to be interesting to see how this shakes out.
Yeah, I think what'll shake out is there's going to be a lot fewer realtors and
Yeah.
over the coming years, which it wouldn't be surprising given I think that I think we had talked about on a prior episode. There's now way more homes for sale there's way more realtors, sorry, than there are
Right.
homes for sale. So that type of mismatch not likely to persist. And if the compensation reward is going to go down, you probably have fewer players in the industry. Okay, something to think about. But I think overall, a good thing to have less fees going to the middleman and more kind of tied to what they're actually doing in terms of selling the property or helping someone find the property. And just a last note on this, there was a study back in 2015. So the US is way higher than something like the UK, Ireland, Netherlands, all these other countries that are paying less than 2% in commission on average for the real estate agents compared to 5.5% for the US. So interesting to see that differential as well. Perhaps this will bring us closer to those other countries. Okay, number 5 here. Should TikTok be banned in the US? Huge debate going on, Peter. As you know, Congress just passed a pretty overwhelming in terms of the vote here. You rarely see this type of bipartisan agreement, which immediately makes me somewhat skeptical. Why are they so much in agreement? Maybe that's just me, but 352 to 65 voting in favor of banning TikTok. Now it goes to the Senate where they're likely to have a little bit more difficulty. They're still evaluating whether to take it on and so on and so forth. But this is an interesting one. There's some arguments you could make for it and against it. And I'm going to just run through these and you tell me what you think is the most compelling arguments for banning it. I think number one, it's national security. They're saying perhaps China's using this to spy on us, and they're using it to perhaps control the population through the algorithm. It's a very addictive thing. I've never used TikTok, but I've seen people on there, and you could stay on there for an hour and you don't even know it. And then the last reason would be just simply fairness or tit for tat. Like, China doesn't allow any of our social media apps in their country, so why should we allow something? And why should we allow a Chinese controlled app in our country? The argument against the ban, in my view, I think this is the strongest one, is perhaps this will be a slippery slope, that the increase in government power in terms of limiting free speech from this bill will set a bad precedent, and we'll see. We might like the ban of TikTok, but we might not like what they use it for in the future. And looking at the language, I've read the bill. It seems very broad in terms of how they're defining a control of by a foreign adversary. I mean, they listed the countries, China, Russia, Iran, and North Korea. But in terms of the control, it's kind of vague. You can argue that someone's being influenced without having control by these countries. And then there's the issue of there's not real definitive proof that we've seen so far that the Chinese government is actually doing what it's accused of doing. Not to say that they're not. More than likely, they're probably doing something with it, but we don't even have that evidence yet. And we're talking about banning it or forcing them to sell it. And then the last thing would be that a lot of people, not me and not you, but a lot of people use TikTok every day. Over 100 million Americans. Some have built businesses off of it. A lot of people use it for marketing, advertising. People spend, I think, crazy amounts of time, 90 minutes per day on average on there. They could be using that time for much more useful things, in my view. But is that alone a reason to ban it? Probably not. So I laid out the arguments here. I'm still kind of torn between the two. Maybe you can convince me of one way or another. It's kind of a tough one.
Well, first of all, I mean, TikTok's not owned by anyone in China. It's owned by a guy in Singapore. And
Mm.
Congress said that we've got to have the data in the United States. And they moved all the data to a company in Texas. I think this is an overreach. It's completely political. It's probably the biggest imposition on constitutional rights since the Patriot Act. I think this is a very big threat to free speech. If you read even a summary of the bill, it is stunning how overreaching it is, and gets into like websites and anything else the government can shut down. I find this, very, very troubling, very politically motivated, has very little to do about our concern about China and more about wanting Americans not to see certain things. And people should be able to put online whatever they want to put online, and people should be able to read whatever they want to read. Everyone's an adult. If you don't like what somebody says, counter it with a relevant argument. I find this incredibly troubling and directionally probably the most concerning thing outside of finance that I see the government doing.
Yeah, that's where I'm leaning to, especially in terms of this argument that they're controlling it without definitive proof. If we look at actually the ownership, you mentioned the CEO's actually was born. They changed the CEO in 2021. He's actually from Singapore, but 60% is owned by global institutional investors. It's BlackRock, General Atlantic, Susquehanna. 20% is owned by the company founders, who are Chinese, and 20% owned by employees, including a lot of Americans, right? So it's kind of like this wave of, I don't know what you want to call it, but it seems I don't know even know that it's populist, because I'm not sure that most people agree with it, but it's taking an idea that okay, China is an adversary, having this data they might use it in nefarious ways, but they're not defining how they're actually doing it. They're not defining it how it's controlled. There's an argument that the voting shares are still controlled by those founders who are Chinese. But to me, it's the lack of specificity and the broad language in the bill would mean to me in the current form, I wouldn't be in favor of it, especially with what we've seen with the Twitter files in terms of the government very willingly trying to interfere with free speech, and this
Yeah.
would just encourage this even more. So I think you convinced me. I was leaning in that direction. The way it stands now, this is not a good bill. This is not a good precedent. And if we're worried about national security, Peter, I can think of a lot of other
Oh yeah, hundreds
Chinese
of other things. Yeah.
things that would come probably before TikTok, right? I mean, we could obviously, if in terms of defense and things like that, we could make that a much stronger argument to say we don't want Chinese control, and I think we're already doing that in many areas over the past few years, figuring out after COVID when we saw the supply chain disruptions that we don't want to be reliant on China, and that to me makes sense. It's just here you're kind of stretching into something different, but there is a potential, and if they could prove that they're
Yeah,
spying and
that's
they're
a
doing
different story.
something nefarious, okay, that changes my opinion. But up until that point, I'm worried. Like you said, they mentioned things like website, so not just an app. What are they going to try to use this for in the future? And once it's passed, we know it's very difficult to change because nobody wants to be the person saying, "Oh, you're in favor of the Chinese government spying on us. If you want to reverse this, no, you can't do that." Okay, we'll see what happens. I think it's going to be more of a struggle in the Senate, but it's an
I
interesting
hope so.
thing because a lot of people use it. But a whole different discussion, Peter. I don't know what your thoughts on this. Forgetting about should TikTok be banned or should they have to sell it? Do you think there should be an age limit on things like this? Like, do you think that is a reasonable thing for Congress to go on, or should parents be the ones ultimately saying whether they're children or not? Because there's a lot of talk, not just with TikTok, but Instagram, these other social media apps, the negative effects that they have on children. And I've definitely seen that with my own kids. So should this be something you think that should only be available to people that are 16 and older? Should they put something on it like similar to cigarettes saying this is a harmful thing and we shouldn't be allowing children to access it?
I have no opinion on it. What do you think? I mean, obviously it's not a positive thing for young kids. There's a reason that parents and Veronica and I were the same way where we didn't let our kids use social for quite a while. But I don't have an opinion on it. It'd be an interesting debate to see.
Yeah, I think from the standpoint of its addictiveness, and the potential for damage, it's very, very high. I have a hard time squaring should should the government be telling parents what their kids should and shouldn't be doing, and if there's an educational aspect to it. What's really fascinating is the Chinese version of TikTok isn't
Right,
even
very
called
different,
TikTok,
very different. Yeah,
TikTok, and it's actually all educational stuff. It's teaching kids how to build rockets and science experiments.
right.
It's
Yeah,
almost fascinating the lengths to which China goes to, and they have limits on how long kids can use it. So, but I see that and I say, yeah, that is great, but in a sense, it's really not so great, obviously,
yeah,
because we don't want a government telling us what we can and can't do. It's something I think that's also a little too late because these kids are already on all of these apps and it's very difficult obviously to pull them off it at this point. So I think ideally I would love for these things to not even exist, but I'm not sure banning it or restricting it
right.
would be feasible. I just think kids would find a way around it probably, or find some other way to do it. So we'll see what happens, but interesting debate. And it's something I think that's going to be, as the election approaches, something that people are going to take sides on one way or another. But we're going to end here. Signal or noise? Two interesting ones here, Peter. This may not be that surprising, but it is surprising compared to where we were back in October 2022. S&P, as you remember back then, was near the low in the bear market. And this investors intelligence with looks at newsletter sentiment, and I know you've talked about this and written about this before. Newsletter sentiment very, very bearish. So at the time, 25% of these newsletters were bullish, and today the S&P 500 is 44% higher than back then. And
Right.
guess what? We have almost 61% of these people bullish.
Yeah.
And if we look at the percentage of bears, it's gone down from 44% down to 14.5%. Is this any type of signal, this extreme bullish sentiment we're seeing today, which is in the top 5% of historical readings?
When the people are very negative, it's usually a positive signal, whether you look at the Michigan Consumer Confidence Survey or this survey. But when people are bullish, it's usually just noise. We really don't know. I mean, the markets, when people are bullish, still just as likely to go up as it is to go down.
Yep, that actually is what the data suggests. But the why are people so bullish? S&P 500 at a 16 out of 18 week run higher. That hasn't happened since the early 1970s. So not surprising to see this many bulls. But here's the thing about sentiment: we often say when it's very bearish, 100% signal. So in the
Yeah.
bottom 5% readings of the bulls, which is what we saw in October 2022, you look at the forward returns for the S&P 500 a year out, you're 19% on average. So huge upside most of the time when you have that negative sentiment, when you have very few bulls. Today, next 12 months, I have it in red there, but it's not red in the sense that it's down. It's just below average. 7.7% has been the average from these types of readings in the past. So definitely less bullish, but definitely not outright bearish. So it's interesting that sentiment extremes, when people are very negative, tend to be somewhat predictive, and when people are very positive, they're less predictive. And I just think that's because the market tends to go up over time, and sometimes people can get very bullish and stay bullish and not get very negative, whereas on the negative side it tends to be like a extreme or a panic, right? That doesn't last very long, similar to large market decline. So definitely what I would say is I'm not as bullish as it was back in
Right.
October 2022. Nobody here should be, but not an outright sell indicator. Just lower your expectations for the next year. We've had
That's right.
a huge run. Don't expect that to continue. And this is just another reason why you shouldn't. Okay, last signal or noise here: 0.5% increase in the unemployment rate. We had the lowest unemployment rate last year at 3.4% since the 1960s. So that was awesome news. Not up very much. We're still below 4%, which is historically very low, but it's the highest since January 2022, and it's up about 0.5% off of its low, which historically, Peter, has meant that you're pretty close to the start of a recession. If we look here, I'm showing sometimes you're there already, sometimes it happens before, and you have to go back to 1945 to 48, that period where it took some time, 9 months, to get to a recession. So are we in a recession today, or are we a few months away from a recession with
I
the
think the
unemployment
unemployment
rate
rate
going
is
up?
I think the unemployment rate is so low that that change is inconsequential, not enough to show a trend. It was artificially low. I mean, when everyone was retiring early and people were home making tons of money with crypto and meme stock, it takes years to work through all of this stuff. And this is actually a very positive signal because it's going to take some of the pressure off of inflation, which takes some of the pressure off of the Federal Reserve. So you've got kind of a almost Goldilocks moment here where unemployment's still exceptionally low, but not crazy low. And combined with lower inflation, combined with a chance the Fed might lower rates. So I'm a no on that. I mean, of course, there's always a recession that could happen for any reason. I wouldn't look at it as an indicator despite the chart.
Yeah, so you're saying this time is different. And we've
Yeah.
seen it be different in many
Yep.
ways, right? This
Yeah.
expansion, and from those distortions in COVID, created a
Yeah.
lot of this time as
That's
different.
right.
And I think in terms of the recession, like being here today, absolutely not. There's no
Yeah.
evidence of that. The fact that wages are still growing the way they're growing shows you that that unemployment rate is not high enough yet to
Right.
be indicating that the labor market is done adding jobs. That doesn't seem likely. We
Yeah.
still have that gap in terms of job openings well above the number of people that are unemployed. So that points to continued gains in the labor market. And it's looking at the fiscal stimulus. We didn't talk about it today, but we'll dig into it on the next Signal or Noise. Looking at the amount of money the government's pouring into this economy. It's just almost very, very difficult, I would say, to have a recession given
Correct.
what's going on in terms of
Right.
what we're borrowing and what we're spending. So for all those reasons, I don't think it's a signal right now of recession. Another thing to note also with employment data is it's subject to huge revisions. And that 3.9% number may not last. So it could be revised lower. We won't know that for months to come. So just be mindful of that as well. And we'll see. We'll look back in a year and we'll see if we were being too optimistic and ignoring this as an indicator. But I don't see any scenario where in February 2024 the recession began. It just doesn't seem very likely given all of the factors that we talked about. All right, Peter, we covered a ton of ground today. Good debate, good discussion as always. If you're watching this on YouTube, we're also available on Apple, Spotify, all the podcast platforms. So hit that subscribe button, hit that like button, send us a review. We love to hear the comments. And we'll see you next time on Signal or Noise.